Hey guys, Max here, and this is your daily market update for yesterday, which was, of course, Monday. The markets were actually green across the board. They were bullish for the most part. Investors were quite happy. Funds were piling into the markets. So let's take a look at exactly what happened. So, as you can see, for the most part, actually, it was green. We had Microsoft and Apple both doing very well each at 3% and 4% gains each. Google up 2%. Amazon was pretty much stagnant. Walmart was back up 3%. Costco was up. Target did fall once more, but in general, stocks were good, with financials actually leading the charge. If you look there in the bottom left, JP Morgan, Bank of America, Wells Fargo, all rising by 5% plus for the day. The S&P 500 as a whole, of course, then performed quite well, rising by 1.9% for the day, with the Nasdaq rising by 1.7%, tech trailing the benchmark index just a little bit. The Dow Jones rose by 2%, and the Russell 2000 rose by a measly 1.1%, which actually isn't great. Now, the rest of the world actually had a strong day as well. Again, green across the board. The FTSE 100 stocks in the UK rose by 1.6%. The Stoxx 600 stocks across the rest of Europe rose by 1.3%, with the MSCI World Index rising by 1.5% for the day at the end. The dollar actually lost some of its recent strengths, falling by 0.7% across the day against an index of other currencies. The euro and the pound both rose by about 1% each, with the euro now sitting at $1.07 and the pound now sitting at $1.26, so both starting to crawl back those losses. Bond yields started their rise again as well, with prices falling as there were outflows from the fixed income asset market. The US 10-year Treasury yield rose by 8 basis points and now sits at 2.86%, encroaching in on that 3% mark again. The German 10-year yield rose by 7 basis points and the British 10-year yield rose by 8 basis points as well. So this exodus away from fixed income assets was worldwide. It wasn't just a US-based situation. Oil prices stayed quite high over the weekend and rose by just 0.2% yesterday alone, with WTI crude oil now sitting at $110 a barrel, still maintaining a very high level, which is of course awful for inflation and our supply chain crisis. Brent crude oil, of course, always sits a little bit higher. It's currently at $113. Gold then saw small inflows as well, rising by about 0.5%. And right now, as we speak, gold is sitting at about $1,860 an ounce. What happened over in the world of crypto then? Well, things actually weren't great. And surprisingly enough, despite the fact that tech stocks rose and equities as a whole rose, Bitcoin and Ethereum and the rest of the crypto market broke that trend, as it has been doing so quite recently, and it fell for the most part. Bitcoin fell by about 4% and now sits just a touch above $29,000. Ethereum fell 5% and now sits just a touch below $2,000. The altcoin market was pretty similar, although a little bit more volatile, with most altcoins falling by somewhere between 5 and 10% for the day. Now, why did crypto fall? Well, there wasn't really any particular reason. It was just some poor sentiment across the board. There were a few bits of news, but really nothing major. The European Central Bank's President Lagarde, that awful woman, came out and basically said that crypto is worthless, but crypto investors really don't care about people saying it's worthless because they've been hearing that for years now. In reality, what this is, it's just a crypto bear market. It's just people losing interest in crypto. They're just not quite as interested in it. It's not as exciting. It hasn't been getting them those huge returns that they've been promised. So they're just taking their money elsewhere, especially as the macro and the monetary environment deteriorates. Now, I see a lot of people talk about fear versus greed, especially in the crypto market. And this idea basically stems from the sayings. There are many of them, but one of them is that when there's blood on the streets, you buy. Another is that it's fear versus greed, and you buy when it's fear, when people are scared, and you sell when they're greedy. But in reality, what I think is the most important thing to pay attention to when talking about risk on assets is really indifference versus hype. If you take a look at the times when Bitcoin has fallen by 90%, when it reaches its bottom, people simply don't care anymore. There aren't articles on the BBC or Bloomberg or CNBC about Bitcoin anymore. People stop talking about it. They stop investing about it. Really, people just become indifferent to it. And on the opposite end of the spectrum, when Bitcoin reaches $65,000 and something like that, Everyone and their mum is interested in it. They're all jumping into the market, excited by the hype, excited by the fear of missing out. And in reality, that is the polar opposite position of indifference. When we move into this bear market, it's already started, I know, but as it develops into a crypto winter and as it lasts for a year, 18 months, 2 years, maybe even longer, well, what I'm looking out for as absolute buying signals is just when no one cares anymore. Take a look at a crypto YouTube channel and when its views have dropped off by 90%, when it used to get 100,000 views a video and now it gets 5,000 views, that's the time to buy. And actually, if that's your idea as well, if you think that it's indifference versus hype as opposed to fear and greed, then now really is the perfect time to get prepared to invest for that indifferent period when people just don't care anymore. I recommend I Trust Capital. There's a link down below in the description. It allows you to invest in crypto through your IRA accounts, your tax advantaged accounts, which can literally save you thousands. Now, stocks were up for the day, as I said, but there isn't really any major news driving that gain. The macro environment is still the same. The Federal Reserve is still raising interest rates. Inflation is still awful. There are still COVID lockdowns in China. The supply chain crisis is still about. So why did stocks rise? Well, it's a little bit hard to pinpoint that exactly, but in my opinion, it really comes down to just change in sentiment, a small bump in the road, a small rally that will, of course, be followed by more declines in the future. I sincerely doubt this decline will last, this rally, sorry, will last for any meaningful period. And of course, that may have been triggered by some very small, bright, shining light, which investors do like, which is, of course, Biden saying that he'll review Trump's China tariffs and he might get rid of them, and that would be good for companies in the short term. Now, why is this good for stocks in the short term? Well, very simply because tariffs are barriers to trade and free trade leads to greater prosperity for everyone in the world. It's put pretty clearly here. A reduction of US-China tariffs is taken to be positive for US-China relations, and that translates to yuan gains. Of course, it also translates to stock gains across the board. Biden said that he is just considering removing some of those tariffs because he didn't put them into place himself. He's left them in for an awfully long time. He obviously wasn't too bothered about it in the past, but with inflation sky high and with his administration absolutely inept when it comes to actually fighting that inflation, he has to look for new methods. Now, my point of view on this is that actually, yes, this would be a good idea and really it should be done if Biden wants to actually tame inflation and try and save the economy. Reducing taxes that prevent trade, that prevent economic growth from happening is a good thing, and this would be bullish for stocks in the short term. I do not, though, think that this is anywhere near enough to reverse the downwards trend that the US economy and the US markets are seeing right now. It's going to need a hell of a lot of a better plan than this, but it is a start, and it will certainly start to ease some of those inflationary pressures. The problem with this is that in the long term, this would be bad for US stocks because it's going to increase the reliance of US supply chains on China, which we've already seen just how chaotic that can be. It's an awful idea to have your greatest enemy, the country that wants to see your downfall more than anything in the world, be absolutely monumental when it comes to you funding and supplying your country with everything it needs. I would like to see these tariffs reduced or deleted, destroyed altogether for the next year or two until inflation is brought back onto the fold, until the economy is back on an upwards trend, and then put them back into place and start the process of removing US supply chains from China, putting them in other countries, bringing them back to the US or other allies. Really just get rid of China's influence on the Western world. Outside of that, what sort of positive news did we have? Well, again, the European Central Bank has come out and basically admitted that actually 50 basis point rate hikes are coming in the future. The European Central Bank is finally getting hawkish. That is about time. It's overdue by about 6 months, but better late than never. And that's a strong sign for inflation eventually being tamed in Europe as well. Of course, this will take time. It's not going to be an instant effect. They haven't actually started that hawkish nature either. They've just said that they're going to become more hawkish. So, of course, we shouldn't exactly believe everything they say. But this is slightly good news too. Again, though, this really isn't major news. It's very minor and it doesn't warrant an increase in the entire markets by 1.5% to 2% across the board. This is just a small bull trap. It isn't major and this rally won't last, in my opinion. Now, in individual company news, we had Snapchat come out with some very interesting news, which is absolutely awful for them. And as a result, their share price has just dropped by 30% after hours, 30% over the course of about 5 minutes, losing tens of billions of dollars in value. Now, what exactly happened? Well, the CEO came out and said that their revenue and their earnings will be a miss for the next quarter. And of course, this second quarter has only just started, so it really isn't a good sign for them. They're also going to be slowing down their hiring. They're going to be taking care to reduce their costs, and they're not going to be focusing on growth at any cost. This comes after Snapchat already missed their earnings in quarter one of 2022. And of course, they're blaming a deteriorating macroeconomic environment, as pretty much every company seeing these poor results is. They're blaming rising inflation and interest rates, as you can see, and of course, supply chain shortages, the labor disruptions in the labor force, platform policy changes like Apple's iPhone privacy feature, where people have to opt in to giving people their data, which makes it harder to run targeted ads. And of course, they're blaming the war in Ukraine. Now, some of those are legitimate concerns and legitimate reasons for what will be some poor performance for Snapchat and other advertisers as well. Things like Apple's iPhone change is a really damaging hit to these companies which rely almost entirely on advertising revenue. The supply chain crisis, though, I don't really see too much relevance. It's a software company. It really isn't much of a hardware company. I don't know how that ties into their supply chains or why it's impacting them so much, but there we are. And of course, the Ukraine war as well actually really doesn't seem to be a major issue for Snapchat. But of course, everyone loves excuses. They love being able to blame other problems and not take control and ownership of their own failings. Now, one of the reasons this is such an important story, an important thing to cover, is because Snapchat doesn't operate in a vacuum. They're not the only social media site that rely on advertising revenue. Of course, there are many, many others. There is Facebook and Twitter and Pinterest and Google. And speaking of those companies, they all fell after hours on this news that Snapchat is doing poorly as well. So what we're really seeing here is Snapchat acting as a bellwether, basically providing guidance for this entire industry for all companies that run via advertising revenue. Facebook was down 7% after hours. Twitter was down 4% after hours. Pinterest was down by a massive 12% after hours, and Google was down 3% after hours. All of this on news that really doesn't pertain to those specific businesses, but just the industry that they operate within. Now, frankly, I saw this coming a long time ago. I've been speaking about it for a long time. Inflation is bad for businesses because people are forced to spend money on their essentials or more money on their essentials like rent and food, and they don't have as much money for discretionary spending. And if people aren't spending money on the adverts they see, then the cost for that advert drops drastically. It did take a little bit longer to come to fruition for us to actually start seeing this, but this is the exact same thing we saw last week with Target and Walmart and Costco all seeing their share prices drop because people are just going to be spending less money and there's less profit for those businesses as a result. I've also seen a lot of people make notes about how reasonably priced many of these businesses now seem to them, with PEs that are either close to average levels or not extortionately high at 100 or whatever like that. And the reality is here that, yes, they may seem appropriately priced now, but you're assuming that they're going to continue to do really well into the future, that they're going to continue to grow. And as a real recession takes hold, well, that just isn't a reality. It isn't absolutely necessary that it happens like that. And the chances are many of these companies, like Snapchat has just shown us, are going to see their earnings decrease. And so their share prices are going to continue to drop as well. Snapchat in particular is in a really bad state right now. As I just said, 30% of its value lost overnight after earnings, not even on an earnings report, actually just on a report that their earnings report isn't going to be very good. Snapchat is now down 66% year to date and 80% from its all-time highs. This is, of course, really, really poor for any Snapchat investor, but this is the new macroeconomic, the new investing environment. Now, we did also get some pretty interesting news from Samsung, which is a $360 billion, that's US dollars, investment in basically their supply chains, but across the entirety of their business, focusing mostly on semiconductors, which is really good to hear. This is a very smart thing for Samsung to do. Of course, right now they are far too reliant on China, just like every other country is in the world and company as well. But they are making efforts to change that and to improve their supply chain, to improve its resilience, and to transfer it over to friendly countries that aren't likely to lash out at other companies. It's also very much abundantly clear at this point that the supply chain crisis is not going to just disappear on its own. We need to hamper demand in order to ease supply chains. The COVID crisis in China is still there and it's getting worse. It isn't getting better, and it's not going to get better either because China is pursuing zero COVID policies as they have done for years, and it isn't working, but they're just inept and incapable of adjusting their strategy. As a result, investing into other supply chains is a brilliant move right now. And actually, I think this is very bullish for Samsung, even if they did lose a little bit of value on this. Yes, it's a very large investment. Yes, it's not the best time in the world to be making that investment. It would have been nicer if they'd made that investment when markets were booming as opposed to when they're going down. But in the long term, I think this is really good news for Samsung. I like to see it, and I'd also like to see other companies go in this same direction. As you can see, they're looking to hire an extra 80,000 people through the next few years. They're going to be putting about $360 billion into supply chains from all of their sides of the business. The business is absolutely massive. Of course, they make electronics and lots of things that use semiconductors, but they also do pharmaceuticals and other things. And they actually have a military division as well. Either way, it's going to be focused mostly on semiconductors, but it's very good news nonetheless. Now, this week we are going to be getting minutes from the Federal Reserve's Open Market Committee meeting from earlier in the month. This basically means we just get a transcript of what was said because as of yet, we know what they come out and decide at the end of the meeting, but we don't know what is said on within the meeting. And this can be quite a controversial thing. If you remember back in January when the bear market basically started, it was all triggered by the FOMC minutes coming out, and it turned out that the Fed was actually far more hawkish than markets and investors had realized. This time round, we could see more volatility. If they talk a lot about 75 basis point rate hikes, for instance, that's going to be very bad for markets, and we'll probably see a day of very bad red, just as we did back in January. On Thursday as well, we're getting US GDP figures for the last month on top of that. Again, if it's bad, if it's negative growth again, then that would be awful for the economy, awful for the markets, good for inflation, but that's just a little bit of a silver lining on a very, very dark cloud at that point. So this could be quite a volatile week for markets. Of course, I'm guessing that as the week progresses on a whole, we're going to see another decline, which would be 8 weeks of steady declines in the S&P. Week after week after week. Hopefully we don't, but let's be honest, we are in a bear market. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. They can help you protect your portfolio against market turmoil through fractional shares of art from world famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, a site that allows you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you think that crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.